Rohr here with an early concise highlight on Tuesday, May 5th, 2015. It's currently 6:45 a.m. U.S. Central Time. Going to be a bit concise today because we're going to skip the other equities outside of the S&P. They're very much in line with yesterday's early concise highlight, and we will mention what's going on there. Also, if you need any extended fundamental background, we have our extended perspective from the weekend posted on Saturday, and we strongly suggest you take a look at that consideration of tail risk is back. There have been quite a few other macro influences that are very interesting of late, and we'll get to those right now. So what does all this mean to the markets? Well, it means we saw a little bit of good news is good news, I guess. Slightly more upbeat data out of Europe yesterday, combined with the, just general upbeat tone of the equities coming off of Friday allowed the S&P future to improve. And it actually opened up, having already pushed back above 2088 to 90, and this goes back to early Friday. And back above 2097, it really wasn't much of a reach for it to consider. It was going to retest the significant downward reversal from last Monday, even though it was a minor down closing price reversal with the higher action last week Monday to a new all-time high at 21.19 and closing lower back below 21.12 to 14.5. We did have a market that failed there last week Tuesday, and yesterday on Monday, it got right back up into that range, but couldn't get above 21.14.5 and stagnated the rest of the day. Now, currently, the market's off to at 21.07. Not really all that weak because, of course, of the gap up yesterday. We'd probably want to see it back below 21.06 to start closing off this gap and ultimately back lower on the week below 21.01.5. And it'll be very interesting after we saw the 30-minute MACD diffuse its push above the upper runaway band on the sideways drift yesterday, whether indeed the hourly can also slip back below the upper runaway band, which would signal some further weakness. However, ultimately it has to get back below 2097, which was the previous downbreak that the market tried to squeeze above, then suffered mightily on Thursday when it was right back below it on the opening on Thursday, and also a key Fibonacci level. Then again, lower supports are once again in place around 2090 to 88 and down into the 2075 to 78 area. As we saw, it slipped below there with only a bit of minor aberration below that level on Thursday before the most recent upswing started. However, the key here is that this has been a very erratic market. Sharp several-day swings followed by resting periods and sharp gaps when it chooses to reverse. So that's what makes this so important, because if it were to push above 21.15 right now, in other words, truly negate the downside reversal, which means it probably go above 19. Next resistance, as we'll see on the intermediate term charts on the oscillator, is until up around the 21.30 area with 21.50 above that. And that pretty much does it for this short-term view of the S&P 500. And we're looking over after that at the intermediate term view.